elephant in the room, we want to expose it. How we are able to use the bank's policies to pay down our loan sooner. Banks are required to assess customers' ability to repay their loan based on an interest rate that is higher than their actual rate. This is to protect the customer's ability to repay the home loan in the event interest rate rises. And that has been a key topic. How many times has your budget gone over?
You go out for dinner one weekend, kids want this at the shop. You've really got to be strict.
Your wage isn't going to decrease when rates go down. So people's mindset is, I can't afford it. How am I going to make the extra repayments if I'm struggling now? Well, you're making the repayments now. Hello and welcome to another episode of From Why to Wealth. In today's episode, I'll be joined by Andrew Willis, Senior Financial Broker. And one key topic we want to discuss today is how we are able to use the bank's policies to pay down our loan sooner. And one of those policies that doesn't really get discussed much when you're with your broker, but Andrew, it's assessment rate. So what I will do is I will
Explain assessment.
What a home loan assessment rate is.
Yeah.
And what that will allow us to do is to understand how that can essentially allow us to pay the loan off sooner or our loan off sooner. So banks are required to assess customers' ability to repay their loan based on an interest rate that is higher than their actual rate. This is to protect the customer's ability to repay the home loan in the event interest rate rises. And that has been a key topic. Yeah, Andrew?
Yeah, sure has.
So the assessment rate applied is based on the higher rate. So let's just say, for example, you come to your broker and you say, what's the best rate you can provide me? And the broker comes in and goes, look, 6.25% as of September 2024. They need to go off to their bank and request what they call a discretionary discount. Then what the bank does on a 6.25, they will then add 3% on that. So the bank deems your floor rate, which is what you've been provided at 6.25, and then they add 3% on top of that. And that gives the bank the buffer and the protection to know the customer has the ability, as I repeated earlier, to make your home loan repayment. So the bank has come out and said, hey, Andrew, your client can afford $550,000 at 9.25 on their income.
Yep.
Your repayment is assessed at the floor rate.
9.25.
Well, it's assessed at 9.25. Sorry, your repayments you'd make on the 6.25.
Payments are made on the 6.25. You're assessed as if it's 9.25.
Correct.
So they feel comfortable. Yeah, okay, you can afford a home loan of $550,000 should rates go up to 9.25 in the time you've got that home loan.
Perfect. Now, we touched on this earlier. Your wage isn't going to decrease when rates go down.
Correct.
So people's mindset is, I can't afford it. How am I going to make the extra repayments if I'm struggling now? Well, you're making the repayments now.
Well, the banks deem that you can make the repayment
Perfect.
on your income at the 9.25, and they're going off what your declared living expenses are as well.
Perfect. So we're just going to make the assumption. So what we've done, we've gone off our average deal size of 551,000. And what we'll be talking about and discussing today is on that average deal size. And look, we are well aware home loans are higher, but this just gives you a bit of perspective on how far ahead you can get in your mortgage if you just apply these simple but basic principles. Let's be frank. Some people don't want you to pay your loan off sooner because you're continually remunerated.
Correct.
Okay. So we'll also just lightly touch on how it benefits you when you do pay your loan off sooner, how you can then, what we like to call in our terms, recycle that. And we will discuss that. So we've worked out a loan amount of the average loan of 551,000 at 6.25, and we worked out the repayments to be 3,393. So if you were to come into the bank today...
Hang on, stop before you go ahead. So what would the repayments be at 9.25?
That's the next step we're going to work out.
Okay.
So at the moment, you've got 551,000 on average loan at 6.25, and we're using an average rate. Your repayment will be 3,393. Yep. Now, the bank's deemed you to be able to make the repayment at 4,533. So what we're saying is at 3,393, and less the 4533, it's 1,140
a month extra.
Extra. The bank's deemed that you can make an extra, you can afford, based off the bank's assessment, 1140 is what the extra repayment that you're not physically making, but what you are doing is you're deemed to be able to afford it at 3% higher.
Correct.
Now, let's not fast forward a year. Let's talk about today. So if you've just taken that loan at 6.25 on today's numbers, and to your point, with that extra repayment, what are we doing with that?
With the extra repayment that you're putting onto your mortgage?
Correct. We're putting it straight into the redraw, or we're putting it
straight into the redraw to reduce the loan amount.
Now, some people have the assumption that putting money straight into your redraw, or you've got spending habits, you don't want to have it, or bad spending behavior, you don't want to put it into your home loan, into your offset. No, it's better out of sight, out of mind. I know personally, I put it into my redraw. Just leave it, set and forget.
Correct.
It doesn't exist.
I mean, it's there for any rainy day, but ideally you don't want to touch it.
Correct. You take that 1140 now, and you're making, do we just assume that you're making the repayments additional monthly, the 1140, or do you span it over 4 weeks?
Well, if you are paying weekly, you're going to make an extra 4 repayments a year.
Yep. Okay.
Which is then going to further reduce the time, the years you've got the mortgage.
So let's to simplify it, we'll do the extra repayments monthly, then we'll do, to your point, weekly, just on the extra repayments. So just reiterating, the extra repayments we are doing will be on a monthly basis, and then we'll come to weekly, and it'll tell you the difference in how, with the extra payments, how sooner you can pay off your loan. So if I put that 1140 as a monthly, you're actually paying your loan off in 16 years and 2 months.
That's at today's rate.
That's at today's rate.
So let's just call it half, because that's a monthly. Once you go weekly, you can pay it off a little bit sooner.
Yeah, so let's go. So you've got 16 years and 2 months on monthly. So that's 285, 1140 into 4 is 285. Just to confirm it, is 285. Now I take that and go weekly. You pay your loan off in 15 months, 15 years and 7 months. So what's an extra less, 5 months less?
Yeah.
Now, some get paid weekly, some do monthly forecasts, some do quarterly forecasts. So on a $551,000 mortgage, I'll scale it back to $1,140 a month. You're actually saving in the vicinity of $346,000. $346,000.
Big numbers.
And that's only over 13 years you're saving it, the balance that you're paying his loan off. So if you dump as much as you can, and that's on today's numbers, that's
the interest rates peaked. We can't see any further rate increases. You know, the Fed's just dropped their rates by 0.5. So it would be a big shock to see the Reserve Bank go up.
And it's interesting to this next point. The Daily Telegraph or the realestate.com.au via the Daily Telegraph have put out a article yesterday. It may be boring to some, but these are the things you got to look for. 4 interest rate cuts in Australia. Now they say they could spark house pricing boom. That's the title, but let's just factor in and narrow down to 4 interest rate cuts in Australia. This obviously has been taken on 0.25 over 4 of them. A lot of factors when it comes to interest rates. People just look at the inflation as the RBA. Yeah, we get it. We understand. But there are so many factors that dictate interest rates, right? Who would have thought, I actually can't say that. Think about it deeper. Your groceries, your petrol, your eggs, your pharmaceutical, all those things factor in and determine the RBA's decision. So what we've then done is we fast forward 1 year.
Yep.
So if we just reiterate, 551,000 on average loan size over 30 years at 6.25 is 3,393 in repayments. At the 9.25, the banks assessed your home loan repayments and the ability to make the repayment at 4,533. That's 1,140 higher. Again, reach out to Andrew or myself if you just a little bit confused with the numbers and probably a hidden conversation that nobody has. But that 1140 in repayments extra could shave 13 years off your mortgage, but more importantly, in the vicinity of 340,000 in interest.
It's a lot of money. A bit in your pocket than the bank's.
There you go. But then what we've gone off and done is said, right, let's just leave the 551. Let's just assume you haven't, the principal amount is still, you're still focused because once your loan limit reduces as the term, so your loan amortizes, right?
Correct.
But your repayment doesn't.
Yeah, that's right. So in 29 years, your loan's obviously not going to be 551. So that's why these numbers probably aren't totally correct, but you're going to actually pay it off sooner because it's not like the loan's going up, it's going down. So
what we've then done is we've factored in, great. If people out there have shown their hands and said, yeah, I can actually do that, right? We've cut our budgets and we can actually do it. Because back then you used to work all the way up to your 65, retire, use your super, pay your mortgage. Now with, your financial planners, your brokers working smarter to educate, the market, it's how do we pay our loan off sooner? Now what we've then gone off and done is we've based it off the 551,000 loan amount. And all we've done is we've reduced the term down to 29 years.
So even if you leave it at that, see what 29 years is going to say, and then do the loan at that, but keep the repayments at the 4.5.
So if we leave, the 551 and we take this to that, correct? Get rid of that just for now. And we go 525 over 29 years. Are you happy with that?
Well, what I was going to say is reduce the actual loan amount to what it would be at 29 years.
You've got to work out the principal, and it's just for this. Yeah,
we'll just leave it at whole figures. 550.
We're leaving whole figures because I've noticed we like to talk whole numbers. So in 12 months' time, your circumstances could change, right? Yeah. We want to talk about today, getting the right behaviors in place for 12 months. Because if you're a homeowner and you're listening to this, you're at the back end of it all. I know it's tough. It's been a slog. Like, I get it. It's been a slog, but we're at the back end of the stress and all signs are leading to there's going to be some movement.
You can see that light at the end of the tunnel.
Correct. So if we go to 525 at 29 years, your repayment still remains at 3393. It doesn't change. Your 3393 will remain there at ending.
You're 4.
Yeah, but so, you're 3393. Yeah. So if we go off 29 years, fast forward 29. Yep, 29 years. If we want to look at paying that loan off sooner and we're just going to go, correct, 1140. Yep. So what we've done is we've reduced the interest rate to 5.25. So that $300 you're now saving.
No, but
so that 300 we've now saving, that 1140 becomes 1440.
Yeah, as long as you still make the repayments at 453.
Perfect.
Yeah, give or take.
So the $300, fast forward 12 months.
Yeah.
Let's fast forward 12 months.
So your minimum loan repayment has reduced by the 300.
Correct.
But you're keeping it at that 4.533, which the bank assessed you could pay when they're at the 9.25.
Perfect. So we're going to still remain paying the 4.533.
Correct.
And throwing that extra 300 into the rest of the term.
Yep.
You've just moved another year off your mortgage.
And
if not more, because this is based off potentially rewriting your loan where we're not really going to do that. But that's just you making the additional payments. And what essentially is going to happen is you're going to have the ability to recycle that money. And people are going, how do you recycle money? All right. If you do the maths, $1,100, let's leave it $1,000 a month is $12,000. So if we go 1140 and we times that, but you do that for 12 months, it's $13,680. That $13,680, that's 12 months worth of 1140 you've been paying extra per month.
Correct. Plus you got the principal that you would have paid off in the minimum repayments as well.
Correct. But if you do that continuously for 3 years, every year you're multiplying your saving or additional repayments by $13,000. So when it comes down to you wanting to do a new kitchen, a new bathroom, there's no need to borrow money.
Correct. It was just sitting in the redraw.
But the benefit of it sitting in the redraw is
you've got access to it, plus your loan is reduced.
Interest-wise.
Yeah, correct.
All signs are leading to reducing your payment sooner. Look, the old method of the revolving line of credit, all is well, but you got to be really stringent. You got to say, right, $5,000 is what I'm going to spend this month because my credit card will only allow me to spend $5,000. But let's be very frank. How many times has your budget gone over?
You go out for dinner one weekend, you know, the kids want this at the shop. Like it's not hard to go over. So yeah, but you've really got to be strict. But
if you just commit $1,100 a month, and that may fluctuate, you know, one month you may go, oh, I need to use that to pay rego for a cup. Well, guess what, guys? You probably don't need to do that because you've just been saving $1,140 over the last 6 months. Your rego's covered. So many people you have conversations with and they've gone, oh, I got my rego due. It's like, yeah, and I'll go back to money.
Yeah.
All we're trying to do is get people into the behavior and the mindset of saying, I can pay my loan off sooner. Well, yes, you can. And then what essentially happens over a 10-year period, on top of you reducing your limit, you every year were growing $13,000. So you got $130,000. So an opportunity may come up to invest. Guess what, guys? You've already committed to making those higher repayments. So if you go off and buy an investment property and it costs you $1,000 out of pocket, what you thought wasn't possible 2, 3, 4 years ago is now possible. Yep. Because how many times you buy an investment property that, if you buy in the right area, costs you more than $1,000 a month? Many houses did, don't misinterpret. Yeah, but
I mean, depending on the house, what it costs, you know, $1 million house, if you got an $800,000 mortgage, I'd say it's going to be negatively geared. You're not going to positively gear that. Especially with rates at this, where they are at the moment. Because, you know, you're looking at 6.54.
But I have to be very clear. This is based on an average deal size across our portfolio. It's not everyone's.
But the numbers will still work the same. Well, in the sense that if you borrow $800,000,
well, let's do the numbers on $800,000.
You still pay your house off in the same time. That doesn't change.
So if you get $800, right, and at today's rate at 9.25 at 30 years, right? No extra repayments. You're $6,581. That's at 9.25. So the average, we're taking the loan up to 800.
Yep.
Repayments are not at 9.25. So remember the assessment rate, they've added a 3% buffer, 6,581. We'll just put that down now too. So we go 6,581. So for those listening, just to put things into context, we're using a CRM, so customer relationship manager, and this is an inbuilt calculator for loan repayments. So the figures that I'm putting in are giving us the repayments to what we want it to, and this is what we use to help educate people. So 800,000 at 6.25 over 30 years is 4,926. So the difference in repayments, 4,926. Now, Andrew, correct me if I'm wrong, but why do I have to pay the extra $1,655? The bank only wants me to pay $4,926. That's the pushback I would get.
I mean, you don't. Mm-hmm. You can pay your loan off over 30 years. You get charged the interest. You know, what do we calculate for? 300,000. So this is obviously going to save you more going off this calculator, but you don't have to make extra. But sacrifice like this that can half your loan term and save you that money, you can put into retirement.
Invest in super.
Invest in shares. And I mean, that's the whole thing around debt recycling. Like if you were to invest in shares, you can withdraw investment loan on your mortgage to then go invest in shares.
Or you can,
that is now tax deductible.
Or you can use that money that you've been saving aside. And, you know, you see our advisors and they've gone, hey guys, you've got 50,000 there.
Yeah.
You could potentially invest the 50,000 to continue making the difference in repayments. However it will work, you got to speak to a trusted advisor for that. But if we work off the numbers, so the difference between, again, just to reiterate, an $800,000 loan at 9.25 is 6,581. over 30 years based off today's rate in September 2024. And then the difference in repayments of 1,655, which is the floor rate, what the bank's giving you your repayments on, 16 years and 2 months, and you're saving $500,000 in interest.
It's a no-brainer.
If you calculate
that interest is non-tax deductible as well, because we're obviously going off owner-occupied loan.
So you're saving $16,666 a year in interest
by using the bank's policy against them.
$1,388 a month. That'll do me.
It's crazy.
That'll do me.
And just, I guess, touching back, like, you know, reducing the loan amount allows you to borrow more if you want to buy an investment property. So, you know, you've now got, let's just say you buy the house for $1 million, 3 years down the track, let's just say 4 years down the track, it's now worth 1.2. Your loan amount started at 800,000.
Yeah.
Let's just say it's down to 600,000 because you've been making that extra repayments. The available equity for that is, just going to have to calculate it. You've got 360,000 available equity in that owner-occupied property that can be withdrawn as an investment loan to put down for a deposit for an investment property. If you hadn't made them extra repayments, you might be sitting at 750 loan amount after 4 years. So, you know, you minus 150,000 from that, you've then only got 210,000 available equity.
So I guess essentially what you're saying is use the bank's policy to your advantage. That's going to allow you to get ahead further. You're not obligated to make that repayment at all, period. But when you really work it out, $500,000 saving, first and foremost, 16,666 in interest per month. And then you worked it out to about $1,300 per year, I apologize. And then you work out to be $1,300 per month. So essentially, in 20 years' time for a 30-year-old, they're 50, 55, 10 years left to the mortgage, and they can potentially... Wages are not going to change. Well, you'd assume at today's...
You assume they go up.
You'd assume that.
Pay rises, you know, new employment.
Yeah, that's not also factoring in if you're in a position where your business has grown, you're pulling out more of a dividend, you're working for somebody, which means you're getting... and you're hitting numbers and you're getting bonuses. That's not factoring in you being able to contribute more money. We're just really using what the banks tells us to use. Hey guys, we're assessing it at 3% above, and we're telling our and educating our platform and saying, hey, make the extra repayments. You're not obligated to, but this is why.
And don't get me wrong, like, things are going to happen if you go on this structure. You're 24, you've just bought your first property. 3 years down the line, you have your first child. Obviously, it's going to be very hard unless, you know, one remains at work and their wages doubled in that time to maintain paying this repayment. But if you stop this repayment for 5 years, you know, you've had 2 kids in that time, then now you're both back working full time. I get it, childcare, schooling, your expenses would have gone up. But if your income has increased and you go back to that strategy, you still may pay your house off in the 20 years as opposed to the 30. Like, be fixated on it has to be the 15 years. If it drags out to the 20, it's still 10 years that you've knocked off your mortgage.
This is just another way, as the old saying goes, put money away for a rainy day. But rather than putting it, and it's weird, people go, I've got $30,000 in an interest earning account, but why? Why wouldn't you put it in your mortgage and save 6% when you're getting 6%? Like, would you rather earn it or save it? But to each his own.
And then if you're saving it, you get taxed on that money.
The end goal is to pay your mortgage down and pay it down as fast as you can. So we're here. There's a lot of content, guys. I get it. I understand that. And there's probably a lot of people going, where do I start? There's a lot of information. Reach out to us. Send us a message.
We can sit down. We can punch numbers.
A lot of content there, but it's something we had to discuss because it's the elephant in the room. The elephant in the room, we want to expose it. So Andrew, thank you for your time. Thanks for tuning in. And you can find us on YouTube, Spotify, and Apple Podcasts for more content.